Paulo Vieira da Cunha, a small interest rate rise is expected. Is that what the Brazilian economy needs?
Definitely, yes, it is. And the whole question is whether they will signal that they will continue so that they will do enough, or otherwise they'll signal that there will be a pause. I think there is very little doubt about the outcome.
Are you worried about a pause?
I would be very worried about the pause. What's happening in Brazil is a curious circumstance. On the one hand, the neutral real rate has come down over the last decade for a number of structural reasons. But on the other hand, for a number of conjunctural reasons, the trade-off between inflation and output has gotten worse. So in some sense, you're needing a higher dosage of interest rate hikes to contain the explosion in domestic demand that through misguided policies was set in place beginning in, I would say, mid-2010, but really stretching back to the pseudo-reaction to what they perceived was the impact of the global crisis on Brazil.
Mr. Tobini, the central bank governor, has predicted or had a forecast of 4.5% inflation. Now, he's admitted we're not going to make that. What's your inflation target over the next 3, 6, 9 months?
Yes, well, I mean, I think Governor Tobini is been very clear that he expects the 4.5% to be reached by end 2012. I think inflation at end 2011 will depend very markedly on what the Copom does. It has the danger, I mean, inflation is going to peak at around 7% in the third quarter, by the end of the third quarter, which is obviously above the ceiling of the target range. And the question is whether from there on it starts to climb down, or if it sort of gets stuck. And my fear is that it could get stuck, and so that we could end the year with inflation close to 7%, and no discernible movement of it converging to the target by end 2012. So my sense is that if they pause, which is my most likely outcome, they will have to retake the hikes early in 2012, or even as early as in December of this year.
Even though commodity prices are now falling, and as we know, Brazil has a reliance on commodities, some would say an over-reliance.
Yes, no, I think that the price of commodities in reais is a critical variable. And so this points out to two of these intervening elements that are critical for monetary policy, which is the exchange rate and the commodity price. And the fact that commodity prices are slowing down is very helpful, but on the other hand, the strong intervention into the currency has not helped on allowing the appreciation of the real to fight off inflation in tradable prices. Even though what one has to focus on is really non-tradables inflation, because services inflation is running at around 8%. Non-tradable prices are running at around 6.5%, and actually tradable prices are running at only 4%. So, even if commodity prices have come down and the real has appreciated, you still got a mix that is fairly explosive.
Fairly explosive. That's an interesting comment to make. I was going to ask you about parallels you might see in the Brazilian economy, notably in the housing sector, and the American economy before the big crash. You've got soaring house prices in the big cities, especially in the likes of Sao Paulo. Credit is easy to get. Do you see similarities there? Does it really worry you?
No. On the credit side, no. There are very, very few similarities. Credit is very hard to get in Brazil. The share of mortgage credits in total credit is ridiculously small. It's in the order of only 5%. The concern is really with credit card credit and consumer credit in general. But even then, I think that the very increase in the cost of credit plus the prudential measures that have been put in place are beginning to slow down. So I don't see a credit bubble in Brazil. I think that credit is already decelerating and will continue to decelerate the credit growth. The issue really is this differential speed, because the real economy is already adjusting downwards and quite rapidly. I think GDP is going to close the year sub 4%. But the mass of nominal demand continues to pump, and it pumps in sort of an inertial aspect almost. So there is this danger that one could be losing the nominal anchor in the economy, or that it could be not really lost, but at least losing the anchoring of it. So that's really the danger. I think that a number of the indicators on the nominal side, if you look at wage growth, which is still real wage growth is in excess of 4%, and if you look at the growth of the wage bill is in excess of 6%, and in particular if you look at the fiscal indicators, because the rise of revenues are going to grow this year probably by 10 to 11% in real terms. So that's going to drive the increase in public expenditures, even if they meet the primary surplus target. So a number of elements keep pumping demand into the system, and that's what the central bank has to curb.
So how, finally, do they curb that to ensure a soft landing?
I think that the only way is through interest rate hikes, because they have put in place a number of credit control measures, and these are working through the system, but they don't work in the same general signaling and effective way as interest rate hikes. I mean, Brazil is a relatively sophisticated market economy, and so just like in other places, interest rates have the biggest bang for the buck. So what is at discussion here is what would be the appropriate level of the interest rate given this differential growth between nominal demand and the capacity of the economy. And my sense is that even if they give another 25 basis points and bring the rate to 12.50, that wouldn't be enough. They probably would have to bring that rate to 13 or 13.25 at some point and leave it there for a while, and that will do the trick, I think. If they bring the rate up to those levels, leave it there for maybe 6 months or so, one would begin to see the realignment of inflation and inflation expectations towards the target.
Okay, Paulo Vieira da Cunha, I'm very grateful to you. Thank you very much indeed for your time and joining us here on Bloomberg. Thank you, sir.